Here are the 3 stocks that I bought earlier this year. Stock number 1, Ulta. Mo, who is the super investor who just recently bought Ulta? Our good friend WB.
Oh, really?
Yeah, you didn't know that?
No.
Yeah, Warren Buffett. Well, I should say this. Berkshire Hathaway recently bought Ulta.
Nice.
And it caused the stock to skyrocket. If you look in the last 3 months, look at this, Mo. This is a 3-month chart.
Wow, what a wild ride.
380 goes up to 400 and some, plummets down to 320. Warren Buffett bought, bam, right up.
Unbelievable.
Now, guys, in full disclosure, I had Ulta and I had covered calls here. I got some of my position taken away right here because the stock skyrocketed and it got taken away early. And this is a risk with covered calls.
Yeah.
You can have your stocks in the US get taken away early with covered calls, but I'm using puts again to buy more. And I didn't get all the shares taken away. Now, Ulta, incredible company from a retail standpoint, Mo. Now, you know, we always talk about how worried we are about retail, right?
Yeah.
But this company still has growing same-store sales. Look at this, Mo. $18.2 billion market cap. Look at this enterprise value. Only $21 billion.
Pretty good
Usually,
for retail.
yeah, exactly. This difference is essentially the net debt. And their cash flow in the last year, $915 million. And the 5-year average, $885 million. So this I look at as a great company. Mo, what would you guess their return on invested capital be? Don't look.
I'm not looking. I don't know, 15%?
28% last year, 23% in the last 5
Pretty
years.
good.
So what does the return on invested capital say, guys? Well, it tells me that the company might have some moat status and they get a good return on the money that's invested in the business. When companies have a high return on invested capital, you want them finding other opportunities to grow their money because when they invest in the company, it tends to go well and it tends to grow. So let's check out the 8 pillars and see what the story is. This is an 8-pillar thriller. All check marks. What was that, Mo?
I would imagine it would be.
You did? Why'd you think that?
It seems like it's a great company just from the basic parameters that we've been looking at.
Yeah, but usually
frankly, you don't get a very... The only thing that I thought would be high or an X would be the PE.
Yeah, but guess what? Just a few months ago, March 14th, the all-time high was 575.
So it would have been.
It would have been X's here on the 5-year PE and 5-year price of free cash flow. Yeah. Guys, look at this. March 14th, 574. August 12th, 318. That's the short-term volatility in markets. That's what I want everybody to realize. Don't worry about the short run. Mr. Market's going to be crazy, emotional, and needs Prozac all the time. What your job is when Mr. Market's having an emotional day and selling a stock for far below its value, don't get worried. Run your numbers, go in the community, talk about the stock, make sure you understand the business, and if it still makes sense and if your thesis is still the same, Mo, what do?
Buy more.
Buy more. Buy more. Don't get caught up in the hype and the fear that's going on. All right? So, what are the analysts saying about Ulta Beauty going forward?
Wow.
Yes, wow is right.
Jeez.
$26 per share in profit this year, going to 43 in the next 5 or 6 years.
Wow.
Retail ain't dead for Ulta.
Clearly not.
Revenue, 11.4 to 15.3. Not a lot of growth there, but when you have a good margin business of 39% with a high return on invested capital, you can really drive up the profit in the business as it grows.
And they've been buying back a lot of shares.
Let's see how many shares they've been buying back. They've bought back 14% of their shares in the last 5 years. Yeah. Now, not necessarily a good or a bad thing. It all depends on the valuation in which they purchase those shares back at. So let's go to my stock analyzer tool. Let's pull up Ulta the last time I did it in our community video. 10-year analysis. I did 3, 5, and 7% revenue growth.
Okay.
9.5, 10.25, 11% profit margin. Same on free cash flow.
Okay.
PE, 15, 18, 21, purely based on the ROIC. Look at this increasing ROIC.
Same on free cash flow, even though it's historically lower.
I did see that.
Lower.
I did see that. And that is a valid point. The 5 year is pretty close, though.
Yeah, that's true.
So can I understand somebody going a little bit lower on this one? Absolutely.
Okay.
PE, Mo, it's retail, but it's a high quality retail. So I'm willing to pay that extra premium still.
I didn't realize they're in Target partnership.
Oh, yeah.
I didn't know that.
You obviously don't go to Target very often.
I do not go to Target.
Yeah, they're right there, the big Ulta sign.
Nor do I go to Ulta.
That's true. And guys, I did a 9% desired return. Remember, no margin of safety here. Just as this is basically my intrinsic value. But if you have the software, you need to put your margin of safety in here. That way you find a cheaper price. Because there's no reason to buy a stock if you're just going to get the market average. You might as well just buy a low-cost ETF. I hit the analyze button. Boom. Low price of 340, high price of 660, middle price of 476. That means even at today's price of 376, it can still give you a 12% return based on a discounted cash flow model.
Pretty solid. Yeah.
Now, guys, don't buy any company just because somebody on the internet does it, and don't buy it just because it's green here. Your job is to make sure it makes sense to you, because there will be bad days. If we have a sudden bear market, you better believe Ulta, as part of the NASDAQ, will go down. You have to be okay with that. You have to be, even if we have a recession, you have to be okay buying that. Stock number 2, Starbucks. They just hired their new CEO.
Yep.
Paid him $1 gazillion and said to him, hey, by the way, you don't have to come to the office.
Saw that this morning.
You saw that this morning? Where have you been? Oh, yeah, you were traveling. That's right. You were stuck.
Yeah.
Guys, Starbucks wants to open 17,000 more locations by 2030.
Jeez.
They already have like 38,000 locations. So still a lot of growth potential. And I was a little apprehensive about the CEO hire. The good news is he has experience in growing because came from Chipotle. And from the time he joined Chipotle to now, they increased their size by 40 or 45%, which is about what Starbucks is looking to do.
And that was only in 2018.
Yeah, correct. But remember, Chipotle is a younger company.
Yeah, that's true.
It's still growing. So I look at this saying, okay, this could work out well for people. Let's look at the 8 pillars here. Okay, so a lot of debt here. I'm not as worried about that because they tend to have prime locations. And a lot of this debt is leases. So I'm not as worried about that. By the way, when I say they tend to have, when was the last time you saw Starbucks with a bad location?
Yeah, that's true.
In a Target.
Yeah. That's
Did you know they're in Target?
Yeah, I knew that.
Oh, good boy, Mo. Good
been in Target
boy.
Forever. Well, also, if you correlate this to Ulta, look at the market cap to enterprise value here versus what we saw in Ulta.
Yeah.
That's the impressive thing about Ulta.
Yeah. Ulta's really impressive for that reason. All right, so we have high PE, high price of free cash flow over a 5-year period, but look at how much the free cash flow is higher, 3.8 billion versus 2.8 billion, significantly higher in the last year versus the last 5 years. All right. And the good news is the free cash flow last year is pretty close to net income. And the 5-year average is reasonably close, within 15% or so. So it's not terrible. Dividend yield here, very high return on invested capital, crushing even Apple, I think.
That's a really large dividend.
So Mo, valid point here. Dividend eats up 2.55 billion.
That's huge.
Why is Starbucks paying such a big dividend?
I don't know.
This is my only thing I don't like about Starbucks. I haven't gotten an evaluation yet because it's still, I have to look at this from a long-term perspective, but that's such a high dividend yield.
I actually never,
especially with a company that's growing.
Right.
What was that, Mo?
Yeah, I mean, obviously you hired the CEO to grow. So his first job should be get rid of this.
And people would flip out. Guys, I want you to hear this. I like getting dividends, but I don't like dividends if there's growth there. And they're going to grow open 40 or 45% more stores in the next 5 years. And you're telling me, hey, let's keep this dividend going. No, take that dividend. It's tax inefficient. Cut it back. Start investing in those stores. Don't take on debt.
Definitely. $2.5 billion.
Oh, look at this.
Plus, oh my God.
Double-digit growth on the analyst estimates for earnings per share. Double-digit growth every year. Wow. 367 to 644.
You looked at their ROIC, right?
Yeah, it's huge. 50%. I already told you that.
Yeah. Good Lord. What the hell are y'all doing with this dividend?
Yeah, I don't get it either. Unless if you had no other good use for the money, I get that. If you couldn't even buy the stock back because it's too expensive, I get that. All right, revenue growth, high single digits, basically. So, guys, you've probably noticed if you've been to our everythingmoney.com website that we are limiting the number of spots every single day for our software community because it gets so hectic. The reason for that, though, is the software as it exists today currently includes everything that we have to offer for retirement, stocks, and real estate. All of these tools right here that we have in the drop-down menu. But now we have 4 YouTube channels. And behind the scenes, we have to make some big changes as we continue to expand. These offers are going to get separated. And the current offer of everything is going away very, very soon. Now, you may remember, if you've been watching us since we started, this software was built selfishly for myself and Mo so that we could use it to make better decisions in all aspects of our money and investing. But as the channel and community have grown immensely since then, it has to become less about me and more about how I can better serve you in the community. Now, the good news is these changes haven't been made yet. So if you join today, you'll be grandfathered in for life with all the data, all of these tools that we have made, and every future tool that we make. So anything we add in the future, you will get. You'll get all of it, and you'll stay in your price tier forever. This is the best deal we've ever offered. So if you're really serious about making money, making better financial decisions, increasing your returns, and more important, sleeping better at night, being surrounded by thousands of like-minded investors, click the link in the description below, everythingmoney.com/sign up. And I'm very confident it'll be the best decision that you will make all year. Now, what's StarBucks worth to us today?
Good question.
So let's go to our stock analyzer tool. SBUX, StarBucks. Okay. Now, I did 4%, 6%, and 8% revenue growth in the next 10 years. When you're growing your stores 3 or 4% a year, plus normal growth of revenue, I think this might be conservative, but I'm okay sticking with that because growing still takes time and effort. And it's still hard to do. I did profit margin of 10.5, 12, and 13.5.
Okay.
I did free cash flow a little bit lower, 10, 12, and 14. But on the high side, it's a higher free cash flow. PE, 20, 22.5, and 25. Because the market average of 15 to 16, with this high and growing return on invested capital, as well as it being StarBucks, deserves a premium. And my 9% intrinsic value return, analyze button, boom. 63 to 66 on the low side, 135 to 140 on the high side, 95 in the middle. What do you think, Mo?
Pretty good. I mean, what do you know what you own them at? 80, 75?
85, sub 85, I think I was buying.
Pretty good.
I think I ended up buying in the low 70s at one point.
That's pretty solid because this is without margin of safety, of course.
This is no margin of safety.
So,
if you want to put in, let's say we want to put in 12% across the board. Yeah. So I'm in on the low side, on the middle side, about there. So I'm happy with that.
Yeah.
Stock number 3, Nike. Now, it's funny. I'm active on Twitter, and I love when people tell me Nike is dead because it's funny to me that when Nike was at $180 a share back in 2021, it wasn't a dead company. Now it's dead. Why? Because news follows the stock price. And it might get worse for Nike in terms of stock price, but that doesn't mean that Nike itself is getting worse. That does not mean that. What I love about Nike, 1, they're still a dominant player. 2, this gross margin, Mo, I think this gross margin is going to continue to go up as they do more direct to consumer.
Yeah, that's their goal right now.
45% gross margin.
Yeah. You
have a bottom line of 10 to 11%. Return on invested capital, 20% very consistently. They pay this dividend, which eats up the 1.7% dividend that eats up $2.2 billion of their free cash flow. Now look at this, Mo. $128 billion market cap, 140 on enterprise value. Very reasonable.
Yeah.
And their free cash flow last year of $6.6 billion compared to 4.7 in the last 5 years.
Yeah.
And it's higher than their net income last year.
Yeah.
So a lot of positives here.
Yeah, I don't have a complaint on that dividend.
Mo, what kind of world do we live in where Nike is just like
not there
or not even dominant?
Is everybody in here wearing Nike shoes? Yep. Tim's not. Tim's wearing
I am. Yeah, 3 of us are wearing Nike shoes. They have Jordan and LeBron for life.
Yeah.
Listen, crazy. I love Steph Curry. I'm one of the few Cavs fans who love Steph Curry. Steph Curry is not the marketability that LeBron is, that Jordan is.
No chance.
Here are the 8 pillars. X's on the 5-year price of free cash flow. But remember, our 5-year PE, but we have a higher trailing 12 months for them. They haven't bought back a ton of shares, which I'm happy to see that. That's a very good thing. Revenue here, Mo, $14 billion increase in the last 5 years that led to $5.2 billion in more free cash flow and $3.2 net income. I love the fact that the free cash flow is up so much more and low debt. Guys, this is just purely, if you're just worried about the 5-year PE, 5-year price free cash flow, all you're doing is waiting. But there still might be more value to this company than the 5-year PE lets on. So let's pull up the last time I did Nike in our stock analyzer tool. Anyone who says you can't make money in large caps is wrong. You can. You have to be ready to pull the trigger when major price disconnects happen. Nike saw an all-time high of 180, and almost 3 years later, it's at $90. What's it at right now? $84. Is that an opportunity? Maybe. So 3, 5, and 7% revenue growth. 10, 11, 12 profit margin and free cash flow margin. I'm assuming then that their gross margin doesn't increase with going to more direct consumer.
Yep.
Now, there is talk that Nike is worried that they pulled back from stores too quickly and they might be going back. Okay.
All right.
Maybe so.
Then it stays similar.
Exactly. And it stays similar. PE. I did 20, 23, and 26.
All right. I like it.
and my 9% desired return, hit the analyze button. And guys, when this is all said and done, if you want to see our 52-week low stocks, we actually get excited when we see stocks fall and analyze them and find opportunities. So if you want to see one of the ways in which we look to find this, watch our next video. But low price of 62, high price of 120, middle price of 87. At the current price, 9.5% return, including dividends. Watch the next video, guys. Thank you very much for your time.